Assalamualaikum and hi everyone. Today my team from Group 7 will be presenting on financial ratio and analysis of consumer product, which is beverage product. Before we begin, we would like to introduce ourselves.
Assalamualaikum and hi, my name is Nulaim Hamdinuddin and my student ID is 2024189367.
Hi, my name is Aina Umairah. My ID student 2024-616572.
Hi, my name is Nur Izzati Zina binti Matajudin. My entry number is 2024-784-6X7.
Assalamualaikum and hi, my name is Nur Najati Yusuf and my ID number is 2024-655-355.
My name is Aiman Hakim bin Abdul Nasir. My number of entries is 2024-134 and 155.
We will present our topic in 4 parts. First is a background of the company. Second is financial ratio and analysis of the company. Third is comparison between companies, and last is a conclusion.
For the first, we will explain about background of the company, that 5 companies that we choose.
So now I will explain about background of company Nestle Malaysia Berhad. The company overview is Nestle Malaysia Berhad was established in 1912 and it originally as the Anglo-Swiss condensed milk company, and now Nestle was leading food and beverage manufacturer headquartered in Petaling Jaya, Malaysia, and operating as a subsidiary of Nestle State of America with operations that produce and sell consumer food and drink product. So the main business is manufacturing, marketing and distribution of food and beverage, including famous brand and products such as Milo, Maggi, Nescafe, KitKat cereals, dairy product, nutrition product and related beverage. It offers approximately 500 halal certified products and serve both domestic and export markets. The latest financial highlights in 2024, Nestle Malaysia Berhad report revenue of about 6.22 billion and a profit after tax of approximately 415.6 million, reflecting a decrease from the prior year due to challenging market condition. So the market position, Nestle holds a strong market position as one of the leading food and beverage companies in Malaysia and is recognized as the largest halal manufacturing and export hub for Nestle globally, underpinned by strong brands, extensive distribution networks and resilient export performance.
We go to the next company, which is Dash Lady. Dash Lady was started in 1963. It was the first dairy company listed in Malaysia. The company produced many types of meat such as children meats and low-fat meats. In 2024, the company earned about 1.45 billion in revenue. Today, it is one of leading dairy companies listed in Malaysia.
I want to present about background company Farm Fresh Berhad. Okay, first is a Farm Fresh Berhad is a Malaysian dairy company founded in 2009 and headquartered in Johor. Second is the company operators in dairy farming, meat processing and the distribution of dairy and food products local and internationally. Third is a product include a milk, yogurt, plant-based beverages, ice cream and butter sold naturally mainly under the Farm Fresh brand. Last, Farm Fresh is a leading local brand in Malaysia fresh meat.
Hi, today I will be presenting on Present and Holdings, also known as FIN420. It is one of Malaysia's oldest and most respected companies, known for its strong presence in the food and beverage industry. FIN420 was established in 1883, which means it has been operating for over 140 years. Its long history shows how the company has grown and adapted over time. FIN420 is a leading company in beverage, dairy and food products. It is active not only in Malaysia, but also in Singapore and several other international markets. This wide presence helped FIN420 reach a large number of consumers. The company offers a variety of products, including soft drink, dairy product, ice cream, and other food items. This range allows FIN420 to meet different customer needs and tastes. FIN420 is known for its consistent financial performance. In addition, it has received awards for quality and innovation.
So, Malaysia Berhad is a publicly listed Malaysian company that manufacture, market and sells bottled water and related beverage. It's one of the largest and most integrated bottled water manufacturer in Malaysia, and it's been operating since 1989. So the company operation revolves around its particular water supply and artisan aquifer located within 400 acre in protected rainforest in Taipei, Perak.
Next, we will explain about financial ratio and analysis of company. First, Nestle Malaysia Berhad. Second, Dash Lady Milk Industry Berhad. Third, Farm Fresh Berhad. Fourth, Fraser and Leaf Holdings Berhad. And lastly is Britzer Berhad.
The current ratio of Nestle based on the chart show a decreasing trend from 2022 to 2024. In 2022, the company recorded a current ratio of 0.71 times. This was a higher ratio that reflects the ability to pay its short-term obligation on time. The quick ratio of Nestle based on a chart show an increasing trend from 0.21 times in 2032 to 0.22 times in 2033. But in 2023 to 2024, there was show an decreasing trend from 0.22 times to 0.2 times. So in 2023, the company recorded a quick ratio of 0.22 times. This was a higher ratio that reflects the ability to pay its short-term obligation without relying on inventory and prepaid expenses. The debt to equity ratio of Nestle Malaysia Berhad based on a chart show an decreasing trend from 4.67% in 2032 to 4.28% in 2023. But in 2023 to 2024, there was shown an increasing trend from 4.28% to 5.47%. In 2024, the company recorded a debt to equity ratio of 5.47%. This was a higher ratio that reflects the amount of debt. Next is the times interest earned of Nestle Malaysia Berhad based on a chart show a decreasing trend from 2022 to 2024. In 2022, the company recorded an interest earned of 20.07 times. This was a higher ratio that firm can meet loan charge and lower risk of defaults. The average collection period of Nestle Malaysia Berhad based on a chart show an increasing trend from 2022 to 2024. In 2022, the company recorded an average collection period of 25.9 days. This was a higher ratio indicating that the firm has problems in collecting debts. The fixed asset turnover of Nestle Malaysia Berhad based on a chart show a decreasing trend from 2022 to 2024. In 2022, the company recorded a fixed asset turnover of 3.51 times. This was a higher ratio that reflects the effectiveness of fixed assets to generate sales. The operating profit margin of Nestle Malaysia Berhad based on a chart show a decreasing trend from 2022 to 2024. In 2022, the company recorded an operating profit margin of 13.55%. This was a higher ratio that indicates better productivity. Next is the return on equity (ROE) of Nestle Malaysia Berhad based on a chart shows a decreasing trend from 2022 to 2024. In 2022, the company recorded a return on equity (ROE) of 99.04%. This was a higher ratio that indicates higher return to shareholders. The dividend payout ratio (DPR) of Nestle Malaysia Berhad based on a chart show a decreasing trend from 98.87% in 2022 to 95.37% in 2023. But in 2023 to 2024, there was show an increasing trend from 95.37% to 101.13% in 2024. The company recorded a dividend payout ratio (DPR) of 101.13%. This was a higher ratio that provides an idea of how well earnings support the dividend payments. Next is the price earning ratio (PE ratio) of Nestle Malaysia Berhad based on a chart show a decreasing trend from 52.83 times in 2022 to 41.85 times in 2023. But in 2023 until 2024, there was shown an increasing trend from 41.85 times to 65.49 times. In 2024, the company recorded a price earning ratio of 65.49 times. This was a higher ratio that indicates the firm's market price is overvalued.
Dash Lady current ratio shows how easily the company can pay short-term debts using its current assets. The ratio stayed below 1 from 2032 to 2034. It started with 1.12 in 2022, dropped to 0.80 in 2023, and slightly improved to 0.83 to 2034. This means the company does not have enough current assets to fully recover its short-term liabilities. Dash Lady quick ratio shows how easily the company can pay short-term debts without relying on inventory. The ratio has been below 1 from 2022 to 2024. It started from 0.59, slightly dropped to 0.32, and slightly improving to 0.37. It means that the company still depends on inventory to pay their short-term obligations. Overall, Dash Lady needs to manage their liquidity carefully. Dash Lady debt to equity ratio shows how much the company used debt to finance its business. From 2022 to 2034, it recorded very low ratio. It started from 2.17 in 2022, slightly increased to 2.51% in 2023, and dropped to 0.80% in 2024. Overall, Dash Lady shows that the company relies mainly on shareholder equity and has very low financial risk. Next, for the time interest earned ratio of Dash Lady Malaysia, it shows that increase from 60 times in 2022 to 19.4 times in 2024. It shows that the company can pay interest using its. The average collection period ratio shows how long the company takes to collect payment from customer. For Dash Lady Malaysia, it takes from 23 days in 2022 to 28 days in 2034. This means the company is slightly taking a longer time to collect payment. The careful management is important to maintain a healthy financial or healthy cash flow. Fixed asset turnover ratio shows how efficiently the company used its fixed asset to generate sales. For Dutch Lady Malaysia, it started from 4.87 times in 2022 and decreased to 2.57 times in 2024. From the ratio shows that the company fixed assets generating less sales per ringgit. For Dutch Lady Malaysia, the operating profit margin show increase from 4.08% in 2022 to 6.0% in 2023 and 8.0% in 2024. This shows that the company has improved in converting its revenue to profit from daily operations. Next, for Dutch Lady, return on equity ratio shows the increase from 11.7% in 2022 to 16.6% in 2023 and 19.3% in 2024. It shows that the company generating more profit from each ringgit invested by its shareholder. The dividend payout ratio of Dutch Lady Malaysia shows how the company balance sharing profit and reinvesting of their business. In 2022, it paid out of 34.0% from its earnings as dividend. This increased to 44.2% in 2023 with increased shareholder returns. In 2024, the payout ratio fell to 33.1%, which means the company keep more money while still benefits the investor. Overall, the Dutch Lady shows that it's managed their profit well. The price earning ratio of Dutch Lady Malaysia shows downward trend. It's decreased from 39.7 times in 2022 to 20.5 times in 2023 and slightly down to 19.80 times in 2024. With a ratio 19.8 times in 2024, it shows that the company showing improved profitability and reasonable market price.
The ratio show a downward trend from 3.61 in 2022 to 2.43 in 2024, indicating decline efficiency although it remains above 1. The trend suggests a need for closer monitoring and improvement. And the quick ratio declined from 2.80 in 2022 to 1.62 in 2023. Then a steady improvement to 2.20 in 2024, but remaining below is 2.022 level. The ratio sharply from 40.70 in 2022 to 65.84 in 2023. Designated to 62 in 2024. Levels remain high and requirement careful management. Second ratio steady from 4.27 in 2022 to 5.68 in 2024, showing improved financial efficiency and stronger ability to meet obligation. The average collection period remains stable, steadily improvement from 30.50 days in 2022 to 30 days in 10 days in 2024, indicating consistent and efficient receivable management. Second, the fixed asset turnover ratio remained steady, moving from 1.30 in 2022 to 1.23 in 2024, indicating consistent asset utilization. The operating profit margin from 9.48% in 2022 to 13.30 in 2024, reflecting improvement in cost control and stronger operational profitability. The second, the return on equity improved steady from 6.34% in 2022 to 8% in 2024. This showing stronger shareholder return and effective equity management. The dividend payout ratio stays stable around 45%, showing a consistent and balanced dividend policy over the 3 years. Okay, second, the price earnings ratio declined from 5.25 in 2022 to 4.24 in 2024, indicating lower market valuation return to earning over the period.
Next, I represent about FIN420. First is current ratio. In 2022, FIN420 recorded a current ratio of 2.06, which increased significantly to 2.95 in 2023, before slightly declining to 2.46 in 2024. This means that for every RM1 ringgit of current liabilities, FIN420 has more than RM2 ringgit of current asset. A ratio above 1 indicates a strong liquidity position. Although there was a small decrease in 2024, the ratio is still high, showing that FIN420 remains financially stable. Next is the quick ratio, which is a stricter measure because it is exclude inventory. The quick ratio was 1.59 in 2022, increased to 2.05 in 2023, and then slightly decreased to 1.79 in 2024. This shows that even without selling its inventory, FIN420 is still able to meet its short-term liabilities. Overall, FIN420 maintained a strong and healthy liquidity position over the 3 years. Next, debt to equity ratio. In 2022, the ratio was 40.44%, which increased to 52.65% in 2023 and 52.78% in 2024. This means that more than half of FIN420 financing comes from debt rather than shareholders' equity. The increase suggests that FIN420 is using more borrowing fund to support its growth, which can improve return but also increase financial risk. Second is times interest earn ratio. In 2022, it was 77.17 times, which dropped sharply to 18.03 times in 2023 and slightly improved to 19.53 times in 2024. This ratio measures the company's ability to pay interest on its debt. Although the ratio declined significantly FNN is still able to cover its interest expenses many times over, indicating that the company is not facing serious financial distress. Average collection period for FNN. In 2022, it was 20.2 days, increasing to 23.2 days in 2023 and 25.9 days in 2024. This indicates that FNN is taking slightly longer to collect payment from customer over time. A longer collection period may affect cash flow, so this is an area the company should monitor. Next is fixed asset turnover ratio. It was 3.16 times in 2022, increased to 3.28 times in 2023, and returned to 6.16 times in 2024. This shows that FNN is able to generate more than 3 times its fixed asset in sales, which indicates efficient use of its production, facilities and equipment. Next, I will explain about profitability ratios, which measure how efficiently the company generates profit. First, operating profit margin. Operating profit margin shows how much profits the company earns from its core operation. In 2022, FNN recorded a margin of 10.02%. This improved to 12.86% in 2023, showing better cost control and operational efficiency. In 2024, the margin further increased to 13.53%, indicating strong operational performance. Second, return on equity. Return on equity measures how effectively the company used shareholders' fund to generate profit. In 2022, ROE stood at 12.85%. It increased significantly to 16.06% in 2023, reflecting strong profit generation. In 2024, ROE slightly declined to 15.18%, but it still remained at healthy level. This indicates that FNN is efficiently managing shareholders' equity despite a small fluctuation. Next, I will explain the market or equity ratios for Fraser and Leaf Holdings Berhad. First, dividend payout ratio (DPR). Dividend payout ratio shows the percentage of profit that the company distributes to shareholders as dividend. In 2022, FNN recorded a dividend payout ratio of 57.43%, which indicates a relatively high return to shareholders. However, in 2023, the ratio dropped to 14.99%, suggesting that the company will retain more earnings, possibly for reinvestment or future expansion. In 2024, the ratio increased again to 54.05%, showing that the FNN resumed a stronger dividend distribution policy. Overall, FNN demonstrates a stable dividend policy and remains attractive to income-seeking investors. Second, price-earning ratio. The price-earning ratio measures how much investors are willing to pay for each ringgit of earning. In 2022 and 2023, the PE ratio remained stable at 20.27 times, reflecting consistent market expectation. In 2024, the ratio slightly increased to 20.95 times, indicating improved investor confidence and positive market perception towards FNN future.
So according to Split Berhad current ratio in 2022, the ratio was 2.1 times, although it's at a good level. Then the ratio then slightly decreased in 2022 to 2.03 times, indicating a little decrease in liquidity. So in the most recent period, in 2024, the current ratio decreased further to 1.75 times, indicating a continuous downward trend or pattern. So for the quick ratio in 2022 was 1.6 times. However, the ratio increased to 1.61 times in 2023, indicating a steady and marginally better capacity to pay short-term debts without depending on inventory assets. So in 2024, however, the quick ratio dropped to 1.41 times in 2024, indicating a minor decrease in liquidity. So the next for debt to equity ratio, Split Berhad had a low debt to equity ratio in 2022 was 22%, showing that the company relied more on equity than debt. So however, the ratio increased in 2023 and 2024. So the ratio was 31% and 33%. So for the interest ratio, Split Berhad was very high in 2022. So the ratio is 74.77 times, meaning that the company could easily cover its interest expense. Although the ratio declined in 2023 and 2024, masing-masing 2023 50.82 times, and for 2024 42.65 times. It remains strong. This shows that Split Berhad still able to meet its interest obligation comfortably and has a low risk of financial distress. So for the collection receivable average collection period in 2022 was 63.70 days, So in 2023, the average collection little rise in 2020 was 65.36 days. So for the 2024, also increased to 67.62 days, continuing the increasing pattern. So for the fixed asset turnover, seperti Zee Berhad, so the fixed asset turnover ratio, fixed asset turnover ratio measures how efficiently the company use fixed asset to generate sales. In 2022 was 1.90 times, meaning that the company made 1.19 ringgit in sale, 1.90 ringgit in sales for every ringgit invested in fixed asset. However, the ratio dropped in 1.11 times in 2023. Then the ratio slightly increased to 1.15 times in 2024. For the operating profit margin in 2022 was 10.24%. However, the margin dropped to 1.42% in 2023. In 2024 also, the profit margin dropped even further to 6.28 times in 2024. So the graph showing that continuous declining trend. So for the ROE, measures ROE measures how effectively the company generates profits from shareholder equity. So seperti Zee Berhad, in 2022 the ROE was 7.49%, and then little increase in 2023 to 8.65%. For the 2024, the ROE also increased to 12.22%. So it showed that continuous upward trend. So for the debt ratio, seperti Zee Berhad, in 2022 the ratio was 36%, and then in 2020 the ratio dropped to 35%. So in 2023 the ratio went back to 36%, continuing the practice of distributing dividend equals to about 1/3 of profit. So for the price earning ratio in 2022 was 12.61 times. So investors were willing to pay 12.61 ringgit for every ringgit in earnings. So the ratio dropped in 2023 to 11.81 times in 2023, so that a slightly decrease in market valuation market valuation. So in 2024, when the ratio went to 13.77 times, indicating higher market expectation for Zee Berhad future.
Next, we go to comparison between the companies. First, liquidity ratio, current ratio, quick ratio. Second is leverage ratio, debt to equity ratio times interest earned. Third is activity ratio, average collection period, fixed asset turnover. Fourth is profitability ratios, operating profit margin, return on equity. And 5, market or equity ratios, dividend payout ratio, DPR. And lastly, price earning ratio, PE ratio.
The current ratio for 2022 based on a chart show that FIN420 Berhad record a current ratio of 3.61 times. This was a higher ratio that reflects the ability to pay its short-term obligation on times. Other than that, in 2023, FIN420 Berhad record a current ratio of 3.01 times. This was a higher ratio that reflects the ability to pay its short-term obligation on times. And lastly, in 2024, FIN420 Berhad also record a current ratio of 2.93 times. This was a higher ratio that reflects the ability to pay its short-term obligation on time. The quick ratio for 2022 based on a chart show that FIN420 Berhad record a quick ratio of 2.8 times. This was a higher ratio that reflects the ability to pay its short-term obligation without relying on inventories and prepaid expenses. Other than that, in 2023, FNM record a quick ratio of 2.05 times. This was a higher ratio that reflects the ability to pay its short-term obligation without relying on inventories and prepaid expenses. Lastly, in 2024, FIN420 Berhad record a quick ratio of 2 times. This was a higher ratio that reflects the ability to pay its short-term obligation without relying on inventories and prepaid expenses.
The equity ratio show very financial strategy among the 5 companies. Nestle measured and Dutch Lady maintain very low ratio, reflecting conservative debt use. FarmFresh has the highest ratio, rising from 40.17 in 2022 to 62 in 2024, indicating high debt dependence. FIN and Spitzer show moderate increasing leverage overall. Nestle measure demonstrates the stronger financial stability due to its minimal reliance on debt. The term interest earning ratio reveals different ability to cover interest among the 5 companies. Nestle measure declined from 27 in 22 to 6.5 in 24, while the Dashlady improved steadily from 17 to 20. FarmFresh remained the lowest, increasing steadily to 4.27 to 5.68, indicating highest financial risk. FNM and Spitzer show high but decline cover, with FNM dropping sharply from 77 to 70 and 90 and Spitzer from 74 and 7 to 54. Overall, Dashlady show the strongest and most consistent interest coverage, while FarmFresh is the weakest.
Now, I will explain about average collection period. This slide shows the average collection period for 5 food and beverage companies from 2022 to 2024, which measures how long each company takes to collect payment from customers. A shorter period means faster cash collection. From the comparison, Nestle and Dashlady have a shortest collection periods across all 3 years, showing very efficient credit and cash management. FarmFresh has a moderate collection period and remains relatively stable over the years. Fraser and Neef, which is FNN, takes a longer time to collect payments compared to most competitors, but we can see an improvement in 2024 as the number decreased. Spitzer record the longest collection period among all companies, indicating slower receivable collection. Overall, this comparison shows difference in operation efficiency among the companies, with Nestle and Dashlady performing the best, while FNN shows gradual improvement. Next, fixed asset turnover. This slide shows the fixed asset turnover for 5 food and beverage companies from 2022 to 2024. This ratio measures how efficient a company uses its fixed assets, such as machinery and buildings, to generate sales. A higher ratio indicates better efficiency. From the comparison, Dashlady and Nestle record relatively high fixed asset turnover, especially in earlier years, showing strong efficiency in using their assets. Fraser and Neef FNN maintains a stable fixed asset turnover across all 3 years, indicating consistent use of each asset to generate revenue. FarmFresh and Spitzer have lower turnover ratio compared to other companies, suggesting lower efficiency in asset utilization. Overall, this comparison shows that while Dashlady and Nestle leads in asset efficiency, FNN remains competitive with stable performance over the 3 years period.
From 2022 to 2024, the operating profit margin for each 5 companies shows a different trend. Nestle Malaysia performed well in 2022 and 2023, but declined in 2024. For FNN, it remains strong and reached its higher margin in 2024, and for Spitzer, it declined for each year. Overall, the margin shows how well each company managed its profit. Return on equity ratio shows how well company use share equity money to generate profit. Dashlady and FarmFresh shows steady growth in ROE, and FNN remains strong and stable. For Dashlady, Malaysia and FarmFresh, it shows steady growth for ROE, and FNN steady and stable, and for Spitzer, it shows significantly improved over the period.
So for the comparison of DPR, so Nestle Malaysia Berhad recorded the highest DPR throughout the period. So consistently at or above 100%, showing an aggressive dividend policy and dividend payments exceeding earning in 2024. So for the FNN Berhad, FNN Holding Berhad showed a noticeable fluctuation with a high payout in 2022, slightly decline in 2023, and recovery in 2024. FarmFresh Berhad maintained a stable and moderate DPR, generally ranging between 40% and 50%, reflecting a balanced dividend approach. For the Dashlady Berhad and Spitzer Berhad adopted lower and more conservative dividend policies, with DPR mostly between 30% and 30% to 45%, and minimal variation over the previous. Overall, the chart highlight clear difference in dividend strategies, with Nestle focus with maximizing shareholder returns, while the other companies balance dividend payments with earning retention. So for the comparison price earning ratio of this company, so Nestle Malaysia Berhad also recorded the highest PE ratio in all 3 years, reflecting strong market confidence and higher growth expectation. So for Dashlady Industry Berhad showed a declining PE trend, suggesting more conservative market valuation and possibly lower growth expectation over time. So for FNN Holdings Berhad maintained a stable PE ratio at around 20%. 20 times, indicating consistent investor expectation. For the FarmFresh, had the lowest PE ratio throughout the period, remaining below 6 times, which may indicate undervaluation or weaker growth prospect. For the Spitzer, were moderate and stable, showing steady market perception. So for the overall, the chart highlight a significant difference in market valuation, which Nestle trading at a premium, while the others company are valued more conservatively. So for the conclusion, the financial ratio analysis shows that the company is in a generally stable financial position. Is able to meet short-term obligation and maintain manageable debt levels, indicating and control financial risk. However, profitability and efficiency ratios suggest that there is room for improvement in cost management and asset utilization. So overall, the company is financially sound, but could enhance performance through better operational efficiency and profitability management.